My loan is already approved? Good. No, I don't want to buy mortgage insurance. This is for investment property. So you're going to waive the insurance, otherwise I'll be taking from another bank. Okay. Good. So I will see you at the lawyer office. Should I buy mortgage insurance for investment property? In this video, I'll be sharing about insurance planning, especially on whether you should buy mortgage insurance to cover your investment property. I'm Gan, licensed financial planner. How much life insurance do we need? Let's imagine you're going into a permanent MCO. Yes, that means your income will stop permanently, and for the rest of your life, you will not receive a single cent of earned income. You are allowed to withdraw all your EPF, cash, sell your investments, and put all your money into one account. Let's call this account your life savings account. From your life savings account, you are going to pay for you and your family living expenses for the next 10 or 20 years, what we call the standard of living basket. Also, you'll be withdrawing from your life savings account to pay your bank loans, including your car loan, housing loan, business loan, and credit card debt. We call this your liability basket. And the last basket is your children's education. Their school fees and tuition fees from primary school all the way to university. How much do we need for each basket? Standard of living basket, liability basket, and education basket. Let's give an example. If your monthly expenses is 5,000 a month, 1 year you will need to spend 60,000, 10 years 600,000, 20 years 1.2 million, and this is excluding inflation. Let's use 10 years. That means your standard of living basket is 600,000. Next, your liability basket, assuming your loans add up to $500,000, you will need 500,000 to take care of your liabilities basket. Lastly, education basket. Assuming your plan is to send your children to attend private college in Malaysia, after accounting for inflation, let's say you need to save 200,000 for one child. If you have 2 children, you need to have total 400,000 for their education basket. By adding up the 3 baskets, in total you will need 1.5 million in your life savings account. What happens if I don't have 1.5 million? Let's say I only have 500,000 in my life savings account. I can buy a 1 million life insurance policy with critical illness coverage. The moment I meet with an accident or major illness such as cancer, stroke, or heart attack, I'll receive a lump sum 1 million immediate cash, and I can inject this 1 million into my life savings account to pay for my standard of living for the next 10 years, settle my bank liabilities, and pay for my children's education. Let's look at the million-dollar question. Should I buy mortgage insurance for my investment property? When we purchase properties and apply for the bank loan, the bank will usually ask you to buy mortgage insurance. In the event that we pass away or become disabled, the mortgage insurance will pay off our outstanding loans and the property is debt-free. Some people may say that you should buy mortgage insurance only for the house you stay in, because if you die or become disabled, your family can continue to live in the debt-free home without worrying about the mortgage installments. However, if you are buying an investment property, there's no need to buy mortgage insurance because mortgage insurance is not compulsory. The argument is mortgage insurance is an expense which will eat into your investment return. If you die, your family can sell off the property and pay off the loan instead of paying insurance premium and transferring the risk to insurance company. An investor can absorb the risk and seek maximum returns. When I advise my clients on their investment portfolio, we should examine the ideal scenario where we can make good returns as well as the worst case scenario where we may incur losses. Let's examine the ideal scenario. I invest in a property at 500,000. To get the maximum return, I will put down 10% down payment and apply 90% bank loan. My down payment, 50k, bank loan, 450k. Let's say I spend another 20,000 on legal fees, stamp duty, and property agent fees. So my total capital outlay is 70,000. 50k for the down payment and 20k for legal fees, stamp duty, and agent fees. To keep my monthly installment low so that my rental can cover my installments and I do not need to top up cash every month, I may apply for the longest loan period, which is 35 years. Current bank loan interest is lowest in history, around 3.2% for residential property. But interest rate is cyclical and goes up when economy improves. Let's use the average 10 years bank lending rate, which is around 4%. My monthly installment for 35 years loan for 50k, 4% interest is 1,987 a month in the ideal scenario. If my rental is 2,000 a month, it is sufficient to pay for my monthly installment. And if my property appreciates by 3-4% every year, in 10 years, my property will increase from $500,000 to 700,000. And my loan would have gone down from 450k to only about 370,000. If I sell the property for 700k, after paying off my bank loan, I'll receive 322k in my pocket. What is the return on my investment? I put in 70k. After 10 years, I get 322k. My investment return is 16.5% a year, which is very high. The reason it's so high is because of 3 reasons. First, I'm using a highly leveraged investment by taking a big loan. I'm buying $500,000 asset using only 70k of my own money. Second, I'm assuming the ideal scenario where I can get good rental income every month and interest rate remains low. So my rental income can offset my monthly installment. Third and most importantly, I'm assuming my property appreciates by 3-4% every year. How will my return look like if I take a life insurance policy to cover my loan of 450k? If you purchase an investment-linked plan, depending on your age, the monthly premium is around $300 a month. And if you surrender the policy after 10 years, when you sell the property, the surrender value is about $20,000. In 10 years, your total premium paid is $36k, and your surrender value, non-guaranteed, around $28k. Your insurance expense is $8,000 over 10 years, or around 800 ringgit a year. 8,000 divided by 10 years. How will this affect your investment return? Let's get back to the scenario. If your capital is 70k, followed by 300 every month for 10 years, and after 10 years, when you sell the property, you receive 322k plus 28k from your policy surrender value. In total, you receive 350,000. What is your investment return? Your return is 14.4%. If you are making money on your investment, the difference is not much. 14% return a year is still a very good return. But how about the worst case scenario? Let's examine the worst case scenario. The worst case scenario is when recession and disaster hit at the same time, what I call double whammy. Imagine if an investor passed away during COVID crisis and left behind a leveraged investment to his family who have no idea how to manage. If someone bought an investment property around 2010 when the market is high, today if he passes away and there's no rental income and the family cannot afford to pay the monthly installment, the bank will put the property on fire sale. What do you think is the bank auction price? Firstly, the market is in a recession. Similar units could be selling at 10%, 20% or even 30% lower than the original purchase price. Secondly, because this is a fire sale and under bank auction, the price can go even lower, maybe 40% or even 50% below the original price. Let's say the property is finally sold 40% below original price. How much is the selling price? It is only 300,000. The bank recovered 300,000, but the loan is 370,000 or even higher because of late penalties. So the family still owe the bank 78,000 after selling off the property. The scariest part is the bank can come after the family estate. When a person passes away, all the assets and debts fall under the estate and is frozen. The executor of the estate need to use the assets, for example, withdraw bank fixed deposit or sell investments to pay off the debts before the family can inherit whatever is left. That's what I call throwing good money after bad money. That's why we hear of people going bankrupt when they pass away. The biggest reason is because they go into multiple leverage investments, borrowing money to buy properties, or taking business loans hoping to get high returns. But when they die at the wrong time, all the assets shrink in value and the leverage investments become bad money. In the end, the family need to sell the assets and throw good money after bad money, and the family in the end gets nothing. Some of us may think, as long as I buy life insurance for my family, when I die, My insurance payout will go to my wife. She can then use the insurance payout to buy back my house and pay for the family living expenses. This is true, provided the wife is not a joint borrower or guarantor. If both you and your wife act as borrower to buy properties or take business loans, when the husband passes away and the wife receives the insurance payout, the insurance money will go under the wife's personal assets. And the wife, being a co-borrower or guarantor, is liable to pay for the bank loan using her personal assets. And this includes the insurance payout she receives. That's why if both you and your wife are co-borrowers or guarantors, you must take up insurance to cover your investment loans. Let me use an example to summarize today's video. If you have two investments to choose, the first investment can pay you 10% a year when market is good, but if you die when market is bad, you lose all the money you invest and maybe lose even more. The second investment can pay you 8% a year when market is good, but if you die or become disabled, you or your family will get back all the money you invest plus a fully paid up property. Which investment will you go for? I will choose the second one. Even though my investment return is lower, but I get the peace of mind. How much is peace of mind worth? To me, it's priceless. And that's why I purchase life insurance whenever I take on new loans for my investment property. Making an extra 1 or 2% will not make me extremely rich, but getting into an accident or falling sick at the wrong time can wipe out all my investments and cause my family the biggest nightmare. I hope that you have benefited from my video. Please share and like the video so that more people can benefit. God bless and see you in my next video soon.